Minutes from last month's Fed meeting showed that most officials judged that one more rate hike at a future meeting would likely be appropriate. Of course, a lot's happened since that last meeting, so we'll talk about that, too. For more on this, we want to bring in Andrew Hollandhorst, who is chief U.S. economist at Citi. And covering the equity angle, we have Elise Ausenbaugh, who is global investment strategist at JPMorgan Global Wealth Management. Welcome to both of you. Andrew, why don't we just start with what the FOMC minutes showed us yesterday? Yeah, one more hike most of them thought was necessary, but since then we've watched yields pick up pretty rapidly, and a lot of Fed officials who have said maybe the markets did their work for them.
It's really interesting because this was only 3 weeks ago that we had Fed officials meeting. 12 out of 19 thought they should hike another 25 basis points in this cycle. But now we have the minutes. Now we've heard from Fed officials. That move in Treasury yields really concerned them. It seems like that's really changed the tone that we've heard out of the FOMC. And I think they're probably not going to proceed with that hike. So we got strong jobs report. I think we're going to get a pretty, slower but still hot inflation reading this morning. But that move in 10-year yields, I think that's what's behind it.
So on pause just to wait and see what happens, even if the CPI is hotter than expected, just like PPI was?
If we have a big surprise on CPI, maybe they could come back and hike in November. Remember, it's not until November 1st, so there's still time. Chair Powell's going to speak again before the meeting, so if they want to put some probability back in the market for that meeting. And then there's December. They could still hike in December. So it's possible they come back and hike, but it really seems like the bar to a further hike is just a lot higher now after that move in yields.
And at least that might explain why you have clients who are feeling a little more confident about jumping into equity markets, too.
I think so. And last week, after, the equity drawdown that we saw, it seemed people were more willing to get involved given valuations pulled back a little bit as interest rates had risen. And generally speaking, we're still calling for the S&P 500 to be back at all-time highs by the middle of next year. So encouraging folks to work that muscle again and start adding exposure to equities.
What happened that was the pullback in equities entirely related to the jump in yields in the Treasury market?
We think a lot of it was. Plus, what we learned coming out of that last Fed meeting and kind of that more hawkish rhetoric. I think people are still trying to grapple with the probability of a soft landing. But it does seem like the market, by and large, has come around to that. So to us, especially given that a lot of that pullback was driven by valuations, it seems to have been a transmission mechanism from that rise in rates.
How does the market just look past everything that's happening, not only in Israel, but the continued war in Ukraine?
Look, we have been doing a lot of work on this, and for us, it's all about isolating the actual economic impact of the conflict. And we do think this could potentially have implications for energy markets. Maybe it puts a floor under oil. It increases the upside risks, but zooming out and kind of thinking through the implications for the domestic U.S. economy and the global economy at large, we don't necessarily think that it's going to have a sustained impact. And that's something that you've seen from prior geopolitical conflicts throughout history as well.
Hey, Andrew, one of the questions is what really happens with inflation from here? We've gone through a soft patch, but you've got oil prices, as Elise just mentioned, that are picking up potentially. You've got potential wage increases as you continue to see a number of organized labor issues where they say they're walking off unless they get really, really big wages. And that's got to play through to other jobs that aren't union, too. And some of the things that brought inflation down may be rolling over, too. You hear about the UAW with the strikes that are now extending. That's going to push car prices back up.
Yeah, this is a very tight labor market. I think that's probably the number one concern for the FOMC here. Now, we've seen some slower, softer wage growth, but if you look at the Atlanta Fed wage tracker, that's the wage number that a lot of economists focus on. It's still sitting up there above 5%. And if you have 5% wage growth, that's consistent with maybe 4% inflation. And by the way, that's what we're going to see in the numbers today. We should see inflation that's coming in 3.5%, 3.6% on the headline, maybe around 4% on the core. That's still well above target. So I think that there is kind of a little bit of a relief here with this soft patch in the inflation data. But to your point, we have a lot of upside risks that are coming up.
What do you hear from your clients, Elise? How are they feeling about things?
I think the biggest question people are still grappling with is whether or not it's worth taking additional risk to pick up a few extra percentage points when cash is giving you such compelling yields But folks are still coming around to the fact that, these elevated yields won't last forever. Reinvestment risk likely is here on the short end of the curve, but people are grappling with whether or not it makes sense to go all the way out on the risk spectrum into something like equities, or if they can reach their goals, sticking to something like core bonds. So we're working through it, but it does seem like sentiment is improving. And our data showed us that last week our clients were net buyers on a brokerage basis within equity markets.
What would change your mind about the idea that the S&P is going to hit a new high by the middle of next year?
I think the ongoing conversation around, even if inflation continues to cool, as real rates stay positive and get increasingly positive, whether or not that's going to shift the narrative around the probability of a soft landing.
Is your expectation for where equities land tied to the idea that rates will be cut by the middle of next year, that they'll come down?
Not so predicated on that. Valuations could help us a little bit as they've come down, but for us, it's entirely going to be driven by earnings upside. So it's really the consumer that we're watching closely and macroeconomic conditions on the whole to get us to those all-time highs by middle of next year.